Hello and welcome everyone to my new video. While doing business, almost all business entities experience difficulty in retaining employees for a longer period of time. There remains every possibility of trade secrets being exposed to their competitors when skilled laborers, or very experienced workers, leave a job. There is not only a very high recurring cost of recruiting and training new employees, with the regular quitting of the workers, but simultaneously, the business drops, as the new employees take time to perform equivalently as their predecessor. In this situation, maximum employer gets puzzled to manage the situation, and think about providing various types of benefits to retain their employees. Once again, when an employee dies, or becomes severely ill, his or her family member comes up to the employer for financial support. Though having no such policy in the business entity, the employer has to give at least some support on the humanitarian ground. If you want to know how the smarter business entities overcome such situations, stay tuned till the end of this video. But before moving on, let me give you a quick introduction of myself. I am Joydeep Basu, the insurance advisor and primary underwriter, working with Life Insurance Corporation of India and Care, which was formerly Religare Health Insurance. I am providing financial protection, optimizing financial assets and minimizing unnecessary taxes to many individuals, businesses and professions. For more than 17 years, I not only replace income when one's income stops, owing to disability, death or bankruptcy, but provides pensions to the retired. I do fund for medical emergencies and future events like child's education, marriage, foreign trips, house building, and I even sort out the dissatisfaction among the employees for the employers, while planning for their lesser income tax commitments and protect their already built assets from their creditors and even court orders, when they unintentionally default in paying them. Welcome back to the topic. Generally, the employers try to retain their employees by giving a salary hike, promotions, and several perks, and added facilities like vehicle advances, house building loans, medical allowances, festival advances, group insurance cover, ESI facility. But is it really enough to retain employees? The employee may get the same, or more hike, in their salary, along with all the facilities, which they are getting from their employer, when they switch to other employer. So, nowadays, the smarter employers are buying employer-employee insurance for their employees, to give them deferred benefits, for retaining them for longer period of time. What is employer-employee insurance? When the employer takes an insurance policy on the life of his employee, it is known as the employer-employee insurance. The premiums of such policy may either paid directly by the employer, or by employees, also at times. Employer-employee insurance is not at all any insurance product, but a particular arrangement between the employer and the employee. So, any products can be given under this scheme, except child plans and pension plans. This arrangement is only possible because the employer has an insurable interest on his or her employees. Any person or entity has an insurable interest in the item, event, or action, if the damage or loss of those item, event, or action may result in financial loss to that person or entity, who can take employer-employee insurance as the employer. The employer can be anywhere, ranging from a private limited company, a public limited company, a partnership firm, a proprietorship firm, trust, society, so anywhere where employees are gainfully employed can take employer-employee insurance. Even loss-making business entities can take life insurance on the lives of its employees under employer-employee insurance. Can all employees get coverage under employer-employee insurance? A person necessarily needs to fulfill certain criteria to prove that he or she is the rightful employee to get coverage under employer-employee insurance. Number 1, they should be drawing monthly salary. Number 2, the employee should be getting pay slips, or Form 16, from the employer. Number 3, income tax return computation of the employee should be showing income under Section 192, and not under Section 194(j) of Income Tax Act. And number 4, bank statement showing salary credit for that employee. Number 5, the individual shareholding of the employee in the employer's business entity should not exceed 51%, or the combined shareholding of the employee and his or her relatives, such as a spouse, children, in-laws, parents, siblings, etc., in the employer company, should not exceed 71%. These are all the prerequisite for being the rightful employee of any organization to get coverage under employer-employee insurance. What are the benefits to the employer under employer-employee insurance? The employee will feel to be more secured and honored. And naturally, the loyalty to the employer is enhanced. It helps to minimize employee attrition rate. The employer is entitled to get exemptions for the premium amount, whether it is under single or non-single mode, under Section 37(1) of Income Tax Act, as business expenses of the firm. Exemption under Section 37(1) of Income Tax Act can bring monetary benefits to the company. What are the benefits to the employees under employer-employee insurance? This scheme works as a reward program for employees and helps in raising their morale. Even though the premium amount is paid by his employer, the employee can claim income tax exemption under Section 80C. Maturity proceeds will be available to the employee only. Entire maturity proceeding will be tax-free under Section 1010D of the Income Tax Act. Insurance policy can be selected in such a way that it provides security to the employees against illness, accident or disabilities, and early death. Death claim, if any, shall be paid to the nominee, nominated by the employee. What is the maximum cover of an employee under employer-employee scheme? The maximum amount of cover shall be determined in terms of the rules relating to the financial underwriting for individual assurance, taking into account the existing life insurance on the life of the individual employee. How employer-employee insurance works. The employer purchases an insurance policy for the employee in either of the two arrangements given below. Type A, the employer is the proposer, and employee is the life assured. Type B, the employee is the proposer, and life assured. In these two situations, the contract will work in two different methods. Let us have a detailed look at it. Type A, employer is the proposer, and employee, the life assured. The policy shall be assigned to the life assured, who, in this case, is the employee, as per an agreement between the employer and employee. The proposal should be signed by a person authorized by employer. A separate letter, mentioning the object of insurance, and the restrictions the employer desires to impose, has to be obtained. Book of accounts, or income tax orders, for the last 3 financial years, of the employer, to prove the profitability. As the premium liability lies with the employer, the employer should undertake to assign the policy to the employee absolutely, upon the employee continuing to remain in employment with the employer for a period specified by the employer. Usual period is around 3 to 5 years. The employer can impose restrictions on the employee to prevent him from surrendering or taking loan from the policy. The employer can continue to pay premium even after the prefixed ownership period and avail the tax benefits. If the employee quits the job Within the specified period, the employer can either surrender the policy, for its surrender value, to the insurance company, or absolutely assign the policy to the employee, as a part of the terminal benefits. Type B, the employee is the proposer, and life assured. No need of assignment of the policy, from the employer. Employee is the owner of the policy, without any restrictions. What are the tax implications on the premium paid, under employer-employee insurance? Before assignment, employer is the absolute owner of the policy. Premium paid are deductible expense of the employer, under Section 37(1) of Income Tax Act. Section 80C benefit shall not be available for the employee, on the premium paid by the employer. On, or after assignment to employee, employee is the owner of the policy. The sum total of the premium, paid by the employer, before assignment, is treated as perquisite, under Section 17(2) v. of the Income Tax Act, and will be added to the taxable income of the employee in that financial year. Premium paid by the employer, after assignment, is treated as perquisite in that financial year, and will be taxed accordingly. Employee can claim Section 80C benefits, even if the premiums are paid by the employer. In short, the premium paid by the employer can be deducted from the profits of the employer, as it is considered as the business expenses of the employer, which in turn reduces the tax liability also. On the other hand, the employee claims the premium paid after assignment under Section 80C and get benefited. Central Board of Direct Taxes, CBDT, Vided, Circular Number 762, dated February 18, 1998, mentioned that the surrender value of the policy, endorsed in favor of the employee, would be taxable, in the hands of the employee, as profit in lieu of salary. But the learned opinion of tax firms, like PricewaterhouseCoopers, is that the aforementioned circular is applicable only for keyman insurance, and in employer-employee insurance, total premium paid by the employer will be applicable. Insurance policy is a movable asset, and the rules applicable will be that of transfer of movable assets, where the expenditure incurred by the employer is applicable. Ernst & Young, in their opinion about the scheme, have clearly mentioned that maturity and death proceedings of an employer-employee insurance policy, where the assignment has not been done, will attract DDS, under Section 194(d)(a) of Income Tax Act. TDS at the rate of 1%, on the taxable component, has to be deducted, before disbursing the maturity proceeds, to the employer. However, as per the amendments, effected in the Finance Act 2002, in case of employees, the perquisites shall not be taxable, whose net taxable monetary salary, after allowing standard deduction, but excluding the value of the perquisite, does not exceed Rs 1 lakh. At the same time, premium will be entitled, for the rebate to the concerned employee, under Section 88, of Income Tax Act 1961, since the premiums paid by the employer are so treated as perks. How to treat various situations of employer-employee insurance. On the event, employee quits the job, before the policy has been assigned to the employee, employer can either surrender the policy and get the surrender value, or absolutely assign the policy to the employee, as a part of his terminal benefits, but when employee quits the job, on, or after assignment to employee, employee is the owner of the policy, and he should pay the future premiums, if any, and can enjoy the maturity proceedings. Maturity amount will be tax-free under Section 1010(d) of Income Tax Act. On death of the employee, before assignment, the death benefit has to be passed to the nominee of the employee, unless it is specifically mentioned in the agreement, but on, or after assignment to employee, if the employee dies, death benefit amount shall be available to the nominee of the employee only, and will be tax-free, under Section 1010(d) of Income Tax. When the policy matures, without being assigned to employee, maturity proceedings shall be received by the employer, and will be treated as the income of the employer, and will be taxed, and TDS will be applicable. But when the policy matures, on or after assignment to employee, the maturity amount will be received by the employee, and is fully tax-free under Section 1010D of income tax. Why the business entities want to defer their income tax liability. Profit made in any financial year cannot be carried forwarded to the following financial years, and will attract income tax. And once the tax is paid, it is lost forever. But losses can be carried forwarded, and get adjusted, with the profits to be made on the following years. This is the only reason for the business entities to defer their income tax liability. Deferment of income tax liability is not at all tax evasion, but is the smarter practice to maximize profits. How the business entities defer their income tax liability, using the employer-employee insurance. Think of a situation where a profit-making business entity can defer the tax payment perpetually forever. Employer-employee insurance provides such an opportunity. A business entity takes a policy for its employees under employer-employee insurance. Premium paid is treated as business expenses of the employer under Section 37(1) of Income Tax Act, and the employer need not pay tax on it. Makes no assignment, as long as the policy is not assigned, no perquisite for the life assured, and the employee is not taxed for perquisites. As assignment is not done, maturity amount goes to the employer. The maturity amount will be considered as business income, and the employer will have to pay tax on the maturity amount. In order to defer the tax liability, employer can take a new insurance policy in single premium mode, using the maturity amount. As new premium paid is considered as the business expense of the employer, no tax liability will be there. So, the future possibilities, which shall be available to the employer for buying employer-employee insurance are: Possibility 1, when business entity continues to make profit, tax liability is postponed till maturity, and the tax liability can further be postponed by purchasing a new policy. Possibility 2, when the business entity makes losses, maturity can be used to set off losses, and get surrender value if situation is worse, or make the policy paid up, and get paid up value at maturity to set off losses. Possibility 3, when the employee of the employer dies, the employer gets the death benefit. Death benefit will be considerably higher than the total premium paid. Tax liability can again be deferred by purchasing new policy for other employees. For better understanding, let us consider an example. Employer-employee insurance, example of benefit. Let us consider an example where a business entity, making a profit of rupees 10 crores and 8 lakhs, takes an insurance policy of rupees 2 crores sum assured on the life of an employee under employer-employee insurance, whose age is 34 years, for a term of 25 years, where the premium paying term is 16 years. The premium of the policy is rupees 9,30,175. While following the calculations shown in the table, it is to be kept in mind that a surcharge of 7% is levied in case the turnover of a business entity is more than rupees 1 crore for a specific financial year, but less than rupees 10 crores. If income is greater than rupees 10 crores, the surcharge will be 12%. From the calculations, as shown in the table, you can understand how the said business entity is making profit of rupees 5,26,216 more every year, for the entire premium paying term of 16 years, resulting in an additional profit of rupees 84,19,460. Please note that the example shown above are as per the interpretations of the existing tax laws, and can vary in the future. Please consult your accountant before taking decisions. If you have any queries, In this regard, feel free to drop a comment below. Stay happy, healthy, and financially protected.